Coffee cups clinked subtly against the background hum of multinational conversations. In the confined halls of Davos, under the watchful eyes of global economic vultures, President Trump's ultimatum crashed like a thunderbolt. What was initially brushed off as another erratic rhetoric soon revealed its razor-sharp edge as an expertly executed maneuver. Under the guise of a bidding war for Goliath Island, more conventionally known as Greenland, an economic chess game was underway, where control over the Arctic and its treasures was the queen on the board. President Trump's proposal to purchase Greenland sent European diplomats spiraling, riveted not by the absurdity of the notion, but by the clandestine realities it implied. An ultimatum structured not on political alignment, but on transactional dominance. The president wasn't merely delivering a speech at the World Economic Forum. He was pulling the strings of a puppet show where the main act involved slapping tariffs ranging from 10% to 25% on key European players if they resisted negotiations. Explosions in market metrics followed with military precision as silver, the steadfast sibling to gold, erupted past historical $99.9 on $180 highs. In a realm where average investors saw silver merely as sparkling jewelry, the asset had transmogrified into a linchpin of international security, a strategic reserve akin to petroleum during the Gulf War. Through the opaque veils of commodities markets, the once indexed industrial metal now glowed as a sentinel, pivotal to the United States' Golden Dome missile defense ambitions. For the initiated, the overnight price surge was no caprice of speculators, but an orchestrated prelude to financial upheaval. Lest we forget, every silent tick towards escalation obliterated short positions and unraveled the portfolios of naive institutions, crushed like porcelain under the leaden impacts of cascading stop-loss triggers. And so, the market's response became a symphony of chaotic strings. Bonds wrenched wildly, while currency traders felt the ground shift under the dollar, reminiscent of seismographs prior to a major quake. The tactical reverberations were felt far and wide as central banks found their hands forced, juggling the flaming swords of inflationary fears against the backdrop of a geopolitical fissure. The big question isn't why this happened. It's why nations allowed themselves to fall into this trap of dependency on strategic metals. To elucidate, examine the mechanics of it all. The yield curve, a reflection of investor sentiment anticipating market turbulence, began to invert once more, provoking unsettling reminders of past economic depressions. The Treasury yield stubbornly held above 4%, yet it was as if silver wore a magician's cloak, slipping through the usually treacherous waters of high yield and into safe haven territory. The allure of real assets over fiat became apparent. Historical parallels unfolded largely uninvited. The echoes of the 1970s oil crisis mingling with unhealed scars from 2008's financial ruins. Once more, authorities faced a diminishing arena of choices. Traditional levers such as interest rates and fiscal stimulus became antique tools in a landscape fully evolved into economic guerrilla warfare. The regents of the world's largest economies found themselves amidst a macabre ballet of no escape, each policy decision mired with inescapable trade-offs. What of the elite, you might ponder? While the masses reacted with predictably rising panic, those harboring capital made calculated, silent sweeps across the chessboard. Institutions and hedge funds began securing footholds in infrastructure, technology, and raw materials, echoing a return to medieval fortifications. Meanwhile, industries like Tesla watched supply lines fizzle, starved of the critical components they needed for innovation and survival. And then there's the climatic tête-à-tête between West and East. Paper pitted against tangible resources, a geopolitical tussle perfumed with the remnants of Cold War alliances, now crumbling under the weight of resource nationalism. China, with resolute intent, fortified silver and rare earth metal stocks behind trade barricades, launching a new paradigm of resource protectionism. For the average individual, down on the ground in all this chaos, the ramifications weren't mere theoretical puzzles. Mucked in the trenches of consumer finance, they saw mortgage rates ripple upward, savings accounts yield diminishing returns, and daily expenses marathon beyond month-end wages. What looms ahead? The script of the future leans towards further volatility. Markets within the next 6 to 12 months resemble a battlefield strewn with ambiguity and pregnant with potential failures. A call to action emerges stark and unvarnished. Emulate the banking giants, shield wealth not through their hollow counsel, but by mimicking their actions. Anchor funds in tangible, irreducible value. In conclusion, the chronicles of this turmoil are thresholds to an era unrecognizable to any tyranny of past market logic. We stand at the edge of historical renewal, underpinned by the stark realization that the battleground isn't merely financial, it's existential. Survive not by multiplicative speculation, but by understanding that in a matrix of uncertainty, real assets, like the once undervalued silver, are worth their weight not just in currency, but in sovereignty itself. As the curtains lifted on the World Economic Forum in Davos, the stage was set not for policy, but for the latest act in a transcontinental chess match, the ultimatum to Europe's stalwarts. Unseen in the public eye, the stakes quickly crystallized into something more formidable than diplomatic posturing, a business proposition with the breadth to sway global trade. The new tariffs threatened to cripple economies if a forgotten chunk of territory, grenadine in name but serenity in nature, Grandland, was not surrendered. Yet, behind the headlines announcing this geopolitical gambit lay a quiet, insidious signal. Silver, once a mere industrial workhorse, it had ascended overnight to a position none predicted or prepared for. Its price shattered previous records, riding an emotional wave of fear and speculation amidst the threat of NATO's dissolution. This isn't simply about a commodity. Imagine, if you will, the defensive grid known as the Golden Dome, an advanced missile shield reliant on silver to work its technological wonders. The U.S. finds itself backed into a strategic corner. Control of this metal is paramount, especially if it is to maintain superiority and safeguard continental defenses. Now, place yourself in the throes of the market's cascading ripple effects. On the debt markets, sovereign bonds shrieked under the weight of potential tariff-induced recessions. Currency traders eyed the euro and the pound with a nervous gaze, watching them teeter against the dollar. All this played out while silver, the supposed safe haven, catapulted skyward, a beacon for distressed capital seeking refuge from fiat uncertainties. Strip away the surface layer winsomeness of economic strategy, and you're left with an exposed core, a revival of mechanistic forces that haven't been sensed since the oil shocks of the 1970s or the financial quakes of 2008. This isn't just an economic inflection point, it's a litmus test for global governance. The shift from legacy market moorings is palpable, revealing a systemic placking that policymakers cannot excavate or maneuver around. In parallel, the kites on the financial chessboard were anything but panicked. While the crowd scrambled to adapt, enormous funds realigned their strategies, seeking shelter in the concrete certainty of physical and technological assets. For companies like Tesla, clipped by the vines of supply constraints, the stakes could mean stagnation or a slip into obsolescence without the critical silver and tech components for their hyper-expansions. Layer upon this the overarching geopolitical theater, a serried line of Eastern strength against fragmented Western resolve. As China doggedly conserves its treasure troves of precious metals behind trade walls, a fresh era of neo-protectionism unfurls, a binary clash of tangible versus paper wealth. Amidst this tumult stands the everyman, the consumer, tethered to a reality where interest rate fluctuations cast shadows over mortgage affordability, savings decay faster than anticipated, and living costs relentlessly outpace incomes. It is here that the immediacy of macroeconomics hits hardest, reducing theoretical policies to palpable financial strains. Peering into the foggy path ahead, uncertainty thrives in a market more akin to a minefield than a stable system. Only the prepared, those who grasp the threads of real value, may emerge from the other side. As we drift forward, there's a definitive imperative. Follow the footsteps of financial behemoths, but not their hollow advices. Be the bank in spirit. Fortify against storms with timeless valuables. Through this intricate dance, we glimpse the dawn of a new epoch. Redefining eras past, this isn't just a financial crossroads, but an existential one, where the prevailing rules bend to the sovereignty of real assets, etched in the annals of market history by the once unassuming metal now known as strategic silver. In the cold, calculated corridors of Davos, a seismic statement was made, an underhanded maneuver cloaked as diplomatic engagement. President Trump, with a cadence of a seasoned poker player, announced a proposition masked in the language of ultimatums. An acquisition of Greenland was no longer a whimsical thought, but a strategic necessity for the United States. This gambit wasn't just about drawing new geographical lines, but about locking in a pivotal piece on the global chessboard, GEO economic dominance over the Arctic, and by extension, the vast mineral wealth it conceals beneath its icy surface. While the media circled around the spectacle, missing the gravity underfoot, the world of high finance and geopolitics felt the tremors. Tariffs ranging from 10% to 25% threatened upon 8 of Europe's key economies weren't mere saber-rattling. They were financial booby traps set to unsettle an entire continent's economic equilibrium unless compliance to this territorial acquisition was met. In a secondary response, silver, a lustrous mirror of unrest, broke through its historical ceilings, touching an astronomical $99 to $180 per ounce. This was not mere commodity speculation, but a bellwether for a potential seismic shift in transatlantic relations, poised to unravel decades of mutual dependency. The market's reaction was visceral. Yields on European bonds soared, echoing a scream across trading floors, a symphony of financial desperation as howl overtook reason. In the United States, Treasury yields held firm, yet the dollar index wavered, hinting at the undercurrents of uncertainty washing away investor confidence. Beneath the surface, structural tremors revealed a foundational instability, reminiscent of bygone crises. The yield curve, that ancient oracle whispering of recessionary yonders, now spelled out inevitable slowdown, a financial froideur drawing upon the lessons of the 1970s oil embargo, a period when the West had to navigate economic headwinds by decoupling from Middle Eastern oil, leaving global markets unraveling at the seams. But unlike then, today's salvation was not found in petrodollars, but in the shimmering allure of silver and its strategic importance to modern technology and military systems. A parallel to 2008 is unavoidable, where previously unheeded harbingers of financial collapse clamored for attention. Yet unlike the subprime domino effect, today's precariousness had a mineral core, critical, finite, and contested. There was no clean exit for regulators. Unlike the oil crisis or financial crash, this saga wasn't one of liquidity, but of material scarcity, the likes of which cannot be synthesized or abstracted away in algorithmic trades or quantitative easing, with central banks shackled by political pressure as the Justice Department shadowboxed the Federal Reserve and threats of spiking tariffs hung like swords of Damocles over NATO's stalwarts. Options were fleeting. Amidst the tumult, the financial kites, those titans of capital, bet their ship on real assets. As silver vaulted into uncharted territory, Tesla and other tech giants felt the strain, their supply lines gasping under the chokehold of limited resources. With soaring demand for renewable technologies, the industrial sector faced abrupt resource recalibrations. Commodity traders, dirtying their hands with elements more precious than gold, glistened with resolve. Yet as constraints tightened, the margins for error evaporated. Across international lines, a deeper conflict brewed. Eastern bloc powers, draped in a curtain of commodity wealth, fortified their hold, a shield against the volatility asset-backed as the West's monetary promises waned. The withdrawal of Chinese silver exports under a banner of strategic embargo painted a picture. The chasm between necessity and possession, between Western thrift and Eastern thriftfulness, echoed the strategies of a new Cold War where resources were the currency. For the ordinary citizen, this climate of capital machinations means one thing: a caustic squeeze on daily life. Mortgages floated beyond grasp, savings eroded by inflation's gnawing edge. The specter of outliving one's means shadowed ever longer in each fiscal summary. What does the future hold? Prepare, brace, and adjust. The next year may see corporeal security in the tangibility of ownership, assets real and dynamic over paper explorations, a renewed focus on groundwork financial resilience. Heed the conduct of monetary powers, but not their whisper. Become the archiver of your wealth in tangible signs, the universal barter of immunity against market dissonance. We stand on the cusp of an epical metamorphosis where precedents tumble in silver. The modest element once known for adornment emerges with absolute clarity, a strategic standard-bearer heralding the shift of ages. In this new order, the superlatives of old become the reactants of new narratives, usual paradigms inverted amidst the sounds of metallic futures. Just beyond the radar of countless headlines and transient news cycles, a chilling prelude unfolds, a prelude to a global economic symphony destined to crescendo with both beauty and terror. Imagine the scene. Amidst the posh halls of the World Economic Forum in Davos, an ultimatum rang out not as political pageantry, but as the prologue of a gargantuan business maneuver. President Trump, the maestro of this audacious gambit, demanded not a handshake, but territorial conquest, Gibraltar in exchange for grains, Greenland for tariffs. This was no trite illustration of policymaking. The stakes soared sky high, casting the ripples of potential economic warfare across the Atlantic. Underneath the politeness of diplomacy lurked the quiet purr of market speculation, a whisper that metamorphosed into a clamor as silver, the unassuming industrial metal, rocketed past a historic $99 to $180 per ounce. It was a declaration of war, not fought with artillery, but with the rustle of trading floors and the strategic positioning of raw resources. The assault was subtle, yet undeniably perilous. An increment in tariffs ranging from 10% to 25% shook the central bank's bastions, churning through European investment channels like an angry current. Markets upheaved, bonds trembled, and currencies braced themselves against the tides of fear and anticipation. Under the cloak of economic rivalry, the true conflict simmered, the unspoken race for strategic dominance in the Arctic, cloaked under the guise of Greenland's acquisition. Silver became the linchpin, its elevation from crafted adornments to a strategic military staple, bridging the chasm between civilian commerce and national defense. Within the profound scaffolding of military might, the Golden Dome anti-missile defense systems, silver would find its true calling. This escalation was akin to unleashing seismic waves across financial landscapes, signaling tectonic shifts for those aware enough to heed them. Yet, to better understand this cascade of events, we must delve into the theoretical mechanics, paint a picture of how financial arteries quite literally pulse to this newfound rhythm. Consider the yield curve inversion observed in late 2025, a precursor of recession, or the reverse repo operation, which siphoned excess liquidity like a financial palliative. These were less economy's heartbeats and more like the refrigerant coolants in an overheating engine, ephemeral solutions with long-term drawbacks. Transport yourself back to the inflation-stricken 1970s or Wall Street's cataclysm of 2008. Similar landscapes of distress were painted then as are now, brushstrokes of policy failures and the relentless gales of desperation swirling in the halls of power. Regulators face a suffocating zugzwang, every move perilous and fraught with unintended financial consequences, yet each inaction exponentially bleaker. Quietly, as markets reeled, the financial oligarchs, the kites of capitalism, kept their course steady. They feasted not on the paper-thin securities of public offerings, but on tangible assets, solidifying their grip in a spiraling world. While technology titans like Tesla strained under supply line constrictions, the very essence of capital allocation shifted, prioritizing materials no longer mere commodities but instruments of survival. On the grand stage of geopolitics, a clandestine battle unfolded as Eastern powers, steadfast under the weight of commodity wealth, entrenched themselves. This gambit was less an economic pivot and more a paradigmatic schism. The West's fiscal instruments, once instruments of influence, now weathered specters beside the East's fortified commodity reserves. China's embargo, a deliberate checkmate on silver exports, munificently displayed the disparity. A resource Cold War waged in futures markets and export quotas. And yet, for the average citizen, this maneuvering filtered down to the street level as a Sisyphean burden. Mortgages rose untouchably ahead. Savings evaporated beneath inflation's unrelenting advance. The fiscal albatross of outliving livelihood cast its shadow wider with each economical shift. Looking ahead, the imperative is clear. Brace for an epic marked by the corporeal security gleaned from tangible investments, assets awaiting conversion into diplomatic currencies resistant to whimsical monetary policies. Allow the financial elite to demonstrate through action a mode of survival not hinged upon precarious whispers, but solidified in reality, a pilgrimage toward the tangible symbols of lasting wealth. We teeter on the brink of an era where silver, the once modest metal, asserts its dominion as a strategic touchstone for ages to transition. Amidst this upheaval, historical norms fold into new realities, and silver, a beacon of strategic value amidst the clamor, heralds the dawn of transformation. The familiar narratives upend, and with them, ancient paradigms cascade. There echoes the metallic clang of futures evolving in real time. The storm that ravaged Davos was more than a political tempest. It signified tectonic shifts in the global order. As President Trump took the podium in Switzerland, he delivered an ultimatum cloaked as diplomacy, a subtle declaration of economic warfare targeting Europe's economic linchpins. The stakes? Gaining control of Greenland, a strategic asset immersed in its Arctic mystique, and the near-monopolistic grasp over silver, the Cerber Copol, that had quietly metamorphosed into a critical strategic resource. Behind the veneer of statesmanship was an economic transaction, where tariffs threatened to soar by up to 25% against major European economies unless they ceded Greenland. This was not merely an exercise in rhetoric. It represented a high-stakes gamble, with the stability of the transatlantic alliance hung in the balance. Markets, attuned to the nuances of power, responded accordingly. Silver, traditionally the lesser sibling to gold in the precious metals family, shattered previous records, reaching an unprecedented $99.280 per ounce. A 221% annual upsurge cemented its metamorphosis from industrial metal to a linchpin in national security vocabulary. The soaring price was a market scream echoing the existential threat posed by the dissolution of age-old alliances and the resultant geopolitical instability. Investment strategies morphed rapidly, a dash from risk to havens of certainty and tangible assets, reminiscent not of safe pastures but concrete bunkers designed to withstand financial Armageddon. In unraveling this fiscal web, the analogy of the 1970s climbs into the narrative frame, when currencies reeled under inflation and trust in paper wealth eroded into nothingness. The echoes of 2008's recession reverberate through the halls of power, the whispers of fiscal policy inertia becoming desperate shouts. Regulators were caught in a game of zugzwang, a situation in which any move made would only worsen their position, trapping them in a chokehold of their own making. And amidst the chaos, the kites, those elusive titans of capitalism, maneuvered with precision born of anticipation and insight. Their stratagems had shifted from the flimsy securities of Wall Street to steadfast physical wealth. As technology moguls like Tesla fought to navigate the shoals of constricted supply lines, the elite were stockpiling assets valued not for novelty, but necessity. For them, investments in commodities were less about portfolios and more about survival, each ounce of silver a shield against financial apocalypse. Geopolitics, complex and multifaceted, became the stage for an unseen war. The East, buoyed by vast reserves of commodities, fortified their position. The West's traditional allure, monetary hegemony, appeared frail beside China's decisive embargoes and Russia's quiet consolidation of metal wealth. This wasn't mere economic realignment, it heralded the twilight of Western fiscal hegemony as influence skewed eastward under the gravity of tangible assets. For the average citizen, this seemed a distant dance of policymakers, yet each decision echoed into daily life, a Sisyphean struggle where wages trailed inflation's relentless climb and the specter of unpayable mortgages loomed large. The future, once a road of choice, seemed paved with inevitability, a fiscal Sargasso Sea with no visible shore. On the horizon, clarity edges in through the murk, a world where safety and continuity hinge not on financial abstractions, but physical certainties. A prescient shift towards tangible investments, assets grounded in reality more than rhetoric, becomes imperative. While the financial elite lay the groundwork, reorienting towards tangible wealth, the prudent see through the veil of monetary policies to what truly sustains through an era of fiscal temerity, the elemental security of commodities. We stand at the cusp, where history and future mesh in the metamorphic value of silver, now more than metal, but a strategic linchpin in a new age. The normalcy of yesterday recedes as new paradigms emerge, echoing the clang of futures being cast in metal, not paper. A transformation is nigh, its cadence resonating through economies and time, a reminder, a warning, and perhaps a guiding star through the tempestuous seas of financial destiny. In this grand theater of geopolitical chess, the most consequential gambit isn't happening in the crowded halls of power, but in the silent tundras of Greenland. As world leaders gathered in Davos for their performative waltz, a seismic overture was playing out away from the public gaze. The overt hostility that marked Trump's threats to impose tariffs ranging from 10% to 25% on 8 European countries was a political pyrotechnic display, but its true essence lay buried beneath layers of strategic maneuvers. The market often revels in immediate reactions, and here it was no different. As whispers of these tariffs circulated in the financial corridors, silver's price rocketed past the unprecedented threshold of $99 to $180 per ounce, a figure not to be taken lightly. This wasn't merely a number on a ticker. It was an omen of the tectonic shifts propelling the world's most valuable resource nexus, the Arctic. Greenland, often dismissed in geopolitical strategy for its icy expanse, emerged as a critical node in military and economic tactics. Trump's pursuit of the territory wasn't just another offbeat episode. It was a calculated attempt to realign global power structures around tangible resources. The Arctic's hidden treasury, comprising rare earth elements, strategic metals, and untapped oil reserves, beckoned as a new frontier of influence where ownership translated into unparalleled leverage. The market's reaction was primal, an instinctual flight into the perceived haven of silver. For decades, silver played a secondary role to its mightier cousin, gold. But in this volatile narrative, silver shed its conventional skin, garnering status as a strategic asset capable of supporting entire military infrastructures like the U.S. anti-missile defense system dubbed the Golden Dome. Behind the curtain, the silent accountants of the finite, commodities brokers and strategic planners watched with intent. As the silver market soared, it wasn't just futures contracts reshuffling, but but entire geopolitical doctrines. Every percentage uptick in silver's valuation rippled through global bourses like a death knell for old alliances, hinting at the unspoken truth. The transatlantic relationship, much like the debated European tariffs, was on fragile ground. While the media narrative dissected Trump's rhetoric, the market's subtle choreography told another story. Silver's ascent was a symphony of supply chain disruptions, stockpile raids, and institutional hedging against currency destabilization. The U.S., by signaling its decisive moves, was nudging the world towards economic recalibration, where the resilience of physical assets trumped the liquidity of financial ones. In the eerie stillness following these announcements, analysis revealed historical echoes. The 1970s oil crisis, the financial crash of 2008, the gold standard abandonment, they all offered parallels where pivotal resources altered the course of nations. This was no different. Each passing headline underscored the harsh truth. The world was regressing to a raw state of value, where a mere commodity could dictate the economic continuum. Faced with this crucible, regulatory bodies found themselves ensnared in a complex zugzwang. Any move, whether it be regulatory easing or tightening, risked either exacerbating inflation or crippling economic growth. The strategic imperative was crystal clear: control resources, shape destiny. Meanwhile, the kites, those titanic investors, with the foresight to navigate through the turbulence, rebalanced their portfolios away from ephemeral valuations towards commodities. Physical assets, once dismissed as archaic in the digital age, now emerged as the bedrock of financial survival. The Teslas of the world, hindered by supply chain bottlenecks and resource scarcity, mirrored the predicament of entire industries. For these visionaries, the future wasn't in paper, stocks and bonds, but in metals, Earth's finite offerings that promised stability when spreadsheets faltered. Globally, the theater of power trembled under new geopolitical alignments. The East, leveraging its wealth in tangible commodities, fortified its economic citadels, showing indifference to the West's paper declarations. China's embargoes and Russia's silent consolidation of metal wealth signaled a tectonic shift where traditional Western monetary dominion faced its reckoning. The West, relying on fiscal maneuvers and monetary interventions, found itself facing off against an eastward consolidation grounded in material wealth. This collision of worlds had tangible repercussions for every household. Inflation rates outpaced wage growth, and the notion of unpayable mortgages haunted suburban streets. Financial planning, once a linear path towards retirement, now seemed a maze with no guaranteed exit. So how does one navigate these stormy seas? Amid a backdrop where monetary policies are increasingly questioned, the sagacious investor turns to the concrete reliability of physical commodities. This isn't a matter of convenience, but one of survival, a hedging against the specter of fiscal volatility. By recognizing the significance of tangible wealth, one aligns with the strategic vision that not only absorbs the shocks of market instability, but thrives on it. And so, the tale unfolds, a dance between history and future woven into a narrative of silver. No longer merely jewelry or industrial input, silver has become the linchpin in the fabric of a new era. Echoing through this narrative is a reminder: in the volatile flux of financial existence, the constants lie in the elemental, the indomitable resources of the earth. As the world teeters on the brink of change, only those who prepare can hope to weather the storm, a testimony to the endurance of commodities as civilization's enduring foundation.